Hey guys, 𝗙𝗙𝗎𝗀𝗧𝗏 from eToro here, and today we're going to be talking about investing in these. Let's get into it. Right guys, really excited for this one. It's a video I've wanted to make for a while. As we know, countries around the world are banning internal combustion engine cars or ICE vehicles, which creates an opportunity for us as investors to invest in the new electric future. And at the heart of this electric future is the electric car, and the heart of the electric car is the battery, the lithium-ion battery. You might think of a car battery as this big metal rectangle filled with little rectangles at the bottom of a car chassis. However, inside those metal rectangles are hundreds, if not thousands, of these little lithium-ion cells. And this little lithium-ion cell at the heart of the electric car is what I want to talk about investing in. And today there's only about 3 main ways that you can do it. One, you can invest in mining for lithium and cobalt. That is going to be the hardest because one, you need to value how many minerals that they have in that particular site. Two, you need to value the contracts that the company has, and so how long do these contracts go on for, how much will they be making off each individual client, and then 3, you need to make sure that no other competitors are going to be providing lithium and cobalt at cheaper prices, because the second that happens, your client's going to move to them. You have no brand power. You are selling identical products to everyone else. And so this is going to be the hardest one to value. And if you aren't sensible, you can be caught out very, very easily. Next is battery factories like QuantumScape, which provide the batteries for Volkswagen. Here you've got a bit more protection because they have a certain level of technology that is harder to replicate. And that provides way more protection. However, because the battery pack is the most expensive part of an electric vehicle, well, companies like Tesla are going to try and produce their own. And so that is the biggest challenge, is the fact that you have to have a much bigger competitive advantage than companies that produce electric cars, because there has to be a reason to go to you. And so far as I'm aware, almost all big car companies are going to have some plan in their future to build their own batteries. Third up is Tesla, and while I love Tesla cars, the issue I've had for years with Tesla, the issue loads of people have had for years with Tesla, to be fair, is that they had a price to earnings of 200, and today their price to earnings is way more reasonable. It's at 40, but it's really hard for a company with a high price to earnings to have explosive share price growth. They may have explosive car sales growth and they may have explosive earnings growth, but the biggest explosion in share price is when a company goes from having a low PE to having a high PE. Like Nvidia has only seen their earnings double a few times, and that has caused their share price to go up 10x, 20x from where it was. So when we look at these 3 options, first we have mining, which in my opinion is too hard. Next, we have battery factories, which in my opinion, they don't have, there's no brands out there that are known as being the brand to go to. I don't think people feel as if they have to go to a particular battery factory. Most car companies seem to want to produce them themselves. And then finally, we have Tesla, which has an extraordinarily high PE ratio, no longer extraordinary, just quite high. It's not a great investment. I'd love to own a Tesla car, but I wouldn't like to hold Tesla stock. So what does that leave us with? Well, for me, if you go over to my eToro portfolio, you can see it in there. It's Volkswagen. Right now, Volkswagen have a really bad reputation in the electric vehicle market, but there's a pretty decent reason for that. That is also very advantageous for investors. The fact is, they are making a killing selling internal combustion engine cars right now, ICE vehicles. People still need internal combustion engine cars. There's still more pumps. My mate, who's a plumber, it definitely makes more sense for him to purchase an ICE vehicle than it does an electric vehicle. Of course, that's going to change in the next 10 years, but for right now, that is the case, and Volkswagen are just supplying a demand. It doesn't make sense for Volkswagen to be entirely invested in EVs because Their main product is internal combustion engines right now. The question is, how easily can they transition to electric vehicles? Well, it seems pretty easily because they've already released a few of them. They've got the ID.3, the ID.4, and they've got the VW ID.Buzz, and I know that they've got other vehicles, but those are the ones that I'm particularly interested in. The VW ID.Buzz happens to be my favorite electric car, period. If I could have any electric car right now, it would be that, although I'd like it converted for a high top so that I can take it camping. The VW ID.Buzz, this isn't an advert by the way, is just the ideal camping car because you could, with a battery that size, you could stay off-grid outside of campsites for way, way longer. And off-grid camping is my absolute fave, just going up to really rural areas and being able to stay warm by having the heating on as much as you like, and being able to charge phones and speakers and laptops to have a little bit of Netflix in the evening and stuff like that, buy a nice lock. Anyway, I digress. The VW ID.Buzz I think is epic. I prefer it to the... God, no, I'm going to stop talking about that. If the question is, can VW enter the electric car market? The answer is certainly yes. The biggest issue for them right now is margin. If Volkswagen was somehow to miraculously discover a way to make their electric cars more profitable, then they would certainly see the profit margins on all of their electric car sales surge, and then shareholders collectively would see that the earnings of Volkswagen were starting to go up. There's this idea in the stock market as well, by the way, that car companies just have low PEs, and it's simply not true. So I have some more drawings for you here. Hope you're enjoying these, by the way. The snail represents the idea that car companies like Volkswagen are slow movers, and the fact is car companies are not just always having low PEs. What they've always had is low and inconsistent earnings. And one of the biggest risks to car companies is, even though they might have an amazing brand like Lamborghini, the second things like if they have something that is sold to the masses, the biggest car companies will be selling to the masses. And if interest rates go up, then their earnings are going to come down. And so they're very, very cyclical. Whenever the market is going through a downturn, whenever we're going into a recession, and basically whenever interest rates are going up, because interest rates can go down in a recession, whenever interest rates go up, it becomes harder for people to purchase cars on finance. And that is how most new cars are bought. That also explains, by the way, Volkswagen's debt. So Volkswagen looks like they have lots of debt. Obviously, they give out their cars on finance. That shows up in their assets and liabilities. So when they sell a car, a lot of their income actually comes in the next 5 years. And so actually they have quite a good amount of income coming in from the pandemic when interest rates were at really record lows. And they had, they got lots and lots of cheap debt at that time. So it might look like they have loads of debt, but it's cheap. And it might look, and you've got to also factor in their assets and liabilities, because without doing that, you don't have an accurate representation of how good of a business Volkswagen is. But anyway, one of the reasons that car companies are slow movers or perceived as slow movers is because they have things like 136 factories worldwide, which any reasonable person would see as an amazing asset. Like, that's insane when you think Tesla has had the success that they've had with about 5 to 10 factories. It's really incredible the network that some of these car companies have, and these factories can be updated. Of course they can for electric cars. They're just making too much money selling internal combustion engine cars right now, and so lots and lots of people are avoiding car companies. They look and they see the price to earnings of 4 on Volkswagen. That's what they have, a price to earnings of 4. They see that and they go, oh, it will always have a price to earnings of 4. No, it's just in the past, there's been no reason for its earnings to grow. And what a lot of people don't realize is that good investing typically is when the share price, the price to earnings go up, not so much the earnings. And so like Nvidia, one of the biggest success stories recently, their earnings have grown up like double, a couple times over. That is incredible. However, their share price has gone up way, way more than double. So for the investors in Nvidia, what they have benefited from is not the earnings going up, it's from the multiple going up. And it's very hard for a company with a multiple of 20 or 40 to go to a multiple of 80 or 160. That would then imply even more growth in the earnings in the future. What is more likely to happen is if Volkswagen's earnings were to suddenly jump by 20, 40 or 50%, then their multiple would probably suddenly jump to something like 20. And so the shareholders of Volkswagen would be benefiting enormously from a relatively small jump in the company's earnings. And what I can see three things happening over the next 10 years, 5 to 10 years specifically, that could cause an enormous jump in Volkswagen's earnings. So the first is in 2025, when Volkswagen begin producing their own batteries. If that is a success, then the next two things that are going to happen become close to becoming a guarantee. So what's happening next year is that they're going to be producing their batteries for the first time. And then by 2030, they plan for 80% of their electric vehicles to be using their own batteries. That's enormous. And they do have quite an impressive electric fleet already out there. But what that's going to do is that means every single one of the electric vehicles that they're currently selling will suddenly sell for a higher margin. And so next is going to happen, once they've gotten, it won't take as long to go to 80%, then it will to 100%. Suddenly they'll be producing electric batteries for 100% of their vehicles, and they'll actually be able to sell to other car companies. And you might think, oh, but if Tesla are producing batteries, won't everyone want that? Tesla are going to have a tough time providing enough electric batteries. They haven't even provided enough electric batteries for their own fleet. And they're going to have a tough time providing electric batteries for the entirety of America, let alone Europe as well. And so what we're going to need is we're going to need multiple companies in on this. When I think about Volkswagen, I think a lot of other people, when they think about Volkswagen and Honda and all these other companies, they see them as BlackBerry to the iPhone. I see Volkswagen for Europe more as Samsung, and I think Samsung have done incredibly well over the past 10 decades. They're not iPhone, but if you'd paid too much for Apple back in the 2000s, you would have done really, really badly. So buying Samsung at a better price would have yielded better returns for a certain period. It wasn't until 2008 that Apple launched the iPhone. And so, yeah, this is the difference between an exciting technology and an exciting company and an exciting investment. And right now, I think Volkswagen are an incredibly exciting investment. A company that is at a price to earnings of 4 and producing really, really good dividends and is about to get into battery production business, which I think is going to be one of the most lucrative businesses, especially if they have cutting edge design and technology. That's something that, what's good about the price is that that's not priced in. So if they do have exciting technology, that's another bit of the multiple. That can be, that can take it from a multiple of 10 to a multiple of 15 if their technology is good and going to be hard for another company to catch up with. And so what I am hoping happens over the next 5 to 10 years, if their earnings go up, then that's great, I'll benefit. So the multiple can stay at 4 and the earnings go up, then I as a shareholder will benefit. However, if their earnings go up significantly and the market starts to realize that Volkswagen is a growth stock that is going to quickly move into the electric car business the second Western countries start banning internal combustion engines entirely, then I can see the multiple going from 4 to 20 even while the earnings are going up. So that is where I think the bulk of the money is to be made in the share price. But yeah, as an investor, I don't trust anyone on YouTube on their opinions. I trust their positions. So if you want to know what my position on Volkswagen is, all you need to do is follow the link in the description, head over to my eToro portfolio, and you can see Volkswagen in there. I have an 8% stake in the business. If when Volkswagen launched the VW ID.5 or whatever, and it has all VW batteries in and it's super affordable or it super outperforms the competition, then I might consider putting more into it. But for now, I'm really happy with my position as it is. The thing that you really need to do if you want to be rich is